Hi, my name is Niël Pretorius. I work for DRDGOLD. A company is in South Africa. We're listed on the Johannesburg Stock Exchange as well as the New York Stock Exchange, and we produce gold from old mine tailings.
Good to see you, sir, and thanks for coming back on the show. We're going to talk to you today a little bit about the macro state of gold at the moment. Obviously, pretty exciting times with the gold price doing what it is, and I think producers are making a lot more money than they perhaps thought they would. But I want to talk to you about how you kind of see the current macroeconomic landscape for gold. What's driving this?
I think a few different dynamics have entered the market in the last few years. So in the past, what we saw was that gold sentiment was by and large driven by whatever was happening in the United States and in the West for that matter. Well, the gold price was driven by sentiment in those markets. That coupled with a number of geopolitical events, whenever energy supply was under threat or when there was some sort of strategic conflict, the safe haven idea of how to hedge your purchase parity by swapping into gold for periods of time, that sort of drove the gold dynamics. What we didn't really see happening was the accumulation of gold at the rate that we witnessed since a few years back, 4 or 5, maybe even a little bit longer years back. And then what that started doing was to an extent offset that one-sided dynamic coming out of the Western markets. So although you would still see that bearish sentiment impacting equity prices, it's almost as though gold started rebasing at higher levels. So whenever America was dumping, there was some jurisdiction somewhere accumulating gold and providing support for the gold price. And what I found particularly interesting was towards 2023, 2024, the latter part of 2024, you saw huge amounts of gold leaving the United States, net outflows of gold. And then suddenly, that may in fact be towards the end of 2023, early 2024, and Americans were selling gold at $1,500 and $1,600 and $1,700, only to see a few months later, and the sentiment was decidedly bearish, only to see a few months later, then it was the same investors, but how in that market again, suddenly the flow of gold started reversing, and they were buying gold back at $500 more expensive per ounce, but we're about ounces here. So that was certainly a disruptive dynamic that impacted the market to behave differently than what I'd become accustomed to in the 20 odd years or so before that I've been involved in the gold space. And then of course, you've got all these conflicts that have now broken out. So the war in Ukraine, the conflict in Gaza, and the rising tensions with Iran having been attacked and so forth and so forth. So there's certainly a whole lot of dynamics. Then, of course, what I think has probably been the most profound impact on all of those, and that's maybe what drove this accumulation of gold dynamic that we've been witnessing, is just the amount of money that's just come into the markets through the quantitative easing. It's just as though a decision was taken at one point that although billions and billions of dollars had disappeared, we'll pretend that it never did, and we'll just put it back into the markets. And I think maybe that spooked certain jurisdictions which held a lot of their foreign currency reserves and dollars, that maybe that's not the safest place to be. So these are the things that I think may have been slightly different and that may have impacted the gold market. I'm not an analyst and I'm not an economist, but what I can tell you is that a year ago the gold price was $2,000 an ounce. This year it's north of $3,000 an ounce. I never thought I was going to see that in my career.
Yeah, I mean, crikey, there's a lot of variables at play here. None of them good, quite frankly. But things like the US dollar. I mean, you're a African-based producer of gold. You can buy gold anywhere in the world. But what does the US dollar fluctuation do for a business like yours?
Well, a dollar weakness means an increase in gold price, and we sell all of our gold in international markets. We sell it in dollars. So we're fortunate. We produce in rands and we local currency and we sell in dollars. So for us, it's happy days when there's a measure of dollar weakness and a high dollar gold price. In the past, what we saw, for example, is when the dollar strengthened, the rand would weaken, and then there would also be some artificial margin for a period of time, and that was usually quickly wiped out by inflation. So a stronger dynamic for us here in Africa was always a slightly stronger dollar price, gold dollar price, or dollar gold price rather, and a slightly stronger rand price. Now we have a situation where the rand is not particularly strong. It's actually weakened against most international currencies, or it does progressively over time. When I started working for DRD, if you buy a dollar for 7 rand, now it sets you back between 17 and 19 rand. But the gold price also increased a lot in dollar terms. So it's a bit of a double benefit, which is really nice.
Well, I guess for you as a producer, you're thinking about two things. You're thinking about obviously cash flow, cold hard cash coming in through the door, and you're also having to kind of play the market game as well. So I'm just wondering, the kind of big factors there is, say when you're looking at central bank buying and other groups buying physical gold is one thing, but things like ETFs and institutional flows drive, in the effects of both those kind of parallel or twin tracks that you're having to navigate. What's most important for you as a business, as a producer, to spend your time on?
Well, but in the past, you could see that ETF trades would sometimes create a bit of false market. So notwithstanding the fact that there was high demand for physical gold, the balancing of whatever it was that they were doing could at times create demand where there wasn't, and at times create oversupply when there wasn't. So it was almost a market within a market, and it was hard to predict. I think the impact that made, and in fact you still see that in some of the other commodities. The impact of that has certainly been diminished somewhat because of the rate at which accumulation of physical gold's been taking place. I don't quite know just how much cover there is for all of the gold tokens out there. It's supposed to be 100%, but I think there might be some overhang. I don't quite know. There are all sorts of other theories as well as about gold that's been loaned out, and those positions need to be closed. It either left the vaults, it never left the vaults, and so forth and so forth. It could be any of those. I don't really try to spend too much time worrying or thinking about that. But what we do try to follow is just where is accumulation taking place? What does the net flows of gold suggest? And are we maybe becoming a little bit too dependent, or is the gold price becoming a little bit too dependent on accumulation in one particular area? Just how much influence is there really in that area, and how much influence is there to maybe have an impact on the gold price, to decide that maybe this gold price is too high and we want it to be different? And to which extent would that market be able to do that? Certainly the sort of volumes that traded in the Western markets up until this counter dynamic started emerging was sufficient to really have steep impact on gold price. Whether you would see something similar emerging at some point in time, I don't quite know. What I do know that is, every time that it goes through one of those thresholds, is you get a little bit more nervous, because you think to yourself, so at what point in time would those that are driving it to these levels start thinking maybe it's a little bit too high and we need to start reversing that? So because it's so hard to interpret, it's really hard to interpret, it's really hard to call. And that being the case, you want to make sure that if you are in a steep capital reinvestment phase like we are at this stage, you really want to get it done sooner rather than later, because it's lovely to see these dynamics, and it's, you can sound really, pretend to be really intelligent and cite all these different dynamics and so forth and how it will endure, etc., but we know it can change overnight, and it'll probably change because of something that none of us are seeing at this stage. So, spend the money now while you can, and make sure that you build in some resilience for future volatility. It would be it's very unlikely, and I'd be very surprised if it just continues at this rate. if these margins that don't start shrinking at some stage.
Like, I agree with you. The kind of synthetic overlay in the space, which is obviously the public markets, the exchanges on which you guys trade, it is not the same as someone giving you cash for something that you're producing. It's, you know, the sentiment driven and emotion has typically, driven values of companies, irrespective of what they're actually doing operationally. What do you think things have changed? Because the thing I've heard a lot of in the past 2 or 3 years is the fact that ETFs are kind of killing some companies because they're very selective with who's on the ETF, and for those who aren't on the ETF, it can be terminal, or they certainly, companies CEOs would like you to believe that. We've seen redemptions at institutional level as well as funds fail to deliver, and then all of a sudden gold's gone on this immense run. Do you think people have rushed back and money is flowing into institutional or an ETFs, or do you think people are just thinking about how do they maybe they need to invest retail, invest directly? I mean, how do you sort of see the investor landscape at the moment?
Yeah, it's hard to say. You're referring to ETFs in terms of index funds, of buying equities, not product itself. Yeah. So I think that one could see that the distinction between, in certain jurisdictions, it's physical gold. Investors are not that interested in owning equities. They want to own physical gold, and they take that gold out, and they take it out of the market almost permanently. It ends up in a vault, and that could at some point or another impact the balance of availability, the balance of stock, etc. Of course, because they've been doing it, it's some resources that would otherwise not have been mined are now being accessed and developed and so forth. So maybe supply will go up. I'm not quite sure. In terms of funds that own a combination, a whole range of or a whole selection of gold shares, of gold equities. I mean, there's an impact, particularly in terms of liquidity. So it's nice to be brought onto some of those funds. It's nice to be able to say, and I think the market, sometimes follow these large ETFs. So if you get included in some of those funds, it may add some liquidity, and we've actually experienced that. And if you then get kicked off, then it has the converse. But that's the nature of the market. And look, as a producer, the one thing that you don't try to do is tell the market what to do and what not to do, or call the market. The market, decides for itself, and it takes a view on where it believes the stock's going to be at some point in future. If they believe that the stock's going to reduce in value, they short it. If they think it's going to increase in value, then they go long. And in the meantime, they manage their portfolio in accordance with their portfolio mandate. We saw many years ago, well, not that many, but sort of 2018, 2019, because of the size of the company at the time, we were removed out of a fairly prominent index fund. And we could see subsequent to that how with very low volume, with very small trades, you could actually move the stock quite a bit, because a lot of the trading in that particular jurisdiction was quantitative trading. It was basically just following whatever the algorithm was saying. So it became easy to move the stock a lot with relatively small trades. The company started doing better, and the stock really exploded in 2021, 2022. It moved from in rand terms from 2 rand 30 to about 15 rand, which we thought was what you could attribute to, firstly, changes in our production profile. There was a project that had come online and it was doing really well, and also a change in gold price. So the company was making a lot more money. But then after it got to 15 rand a share, this particular fund came back into the stock and created liquidity that wasn't based on anything other than the fact that it was creating liquidity, and it added another 10 rand to the stock, which got me a little bit nervous, because you want to be in a position to, somewhere or another, based on fundamental support the value that the market's attributing to the stock of your company. at any particular point in time. But I mean, those are the mechanics of the market. And the reason why I'm in production and not managing other people's money is I think I understand gold production a little bit better than I understand the equity markets.
I mean, I think you referenced some other asset classes earlier. I mean, gold's obviously, say, gone on a tear, but are there any other asset classes that you'd compare to gold at the moment, or any other asset classes that you'd consider being in?
Well, but ourselves, no. But myself as an investor, I mean, what you do see is that we are competing a little bit in terms of dollar hedge and so forth. We are competing a little bit against crypto, or we did at some point or another. I don't know if that's run its course, if there's really still, a significant move out of gold shares and into, or out of gold for that matter, into crypto. Crypto seems to have picked up recently because of changes in the regulatory dispensation, and maybe it's become a little bit more organized and attractive. I'm not quite sure. What I do find interesting is that, I mean, the one thing that we don't see is movements between tech and gold stocks, because maybe investors in tech stocks they're more comfortable with well, I don't want to say unhealthy, but I can't think of another word, PE ratios and so forth. So I'm not sure if there's any competition in that regard. It's maybe just a different sort of mindset.
Well,
but I think that at some point or another there may have been a little bit of a competition for capital between let's say gold and crypto.
Well, let's talk about those sort of longer term risks that investors sometimes underestimate, and maybe talk about fundamentals. Okay. So what are the key metrics that you believe investors should focus on when they're evaluating gold miners? What's important?
Look, I mean, I'll tell you what it is that we tell the market at this stage, and this is how we try to package our own value proposition. And for some investors that would be attractive, and for others it wouldn't. So obviously, and this is maybe because of how I was brought up, but I believe that a business is there to generate cash flow. So we try to position the business in such a way that we generate sufficient cash to offer a dividend. And as I say, not all investors like that, but because this is part of our value proposition, we hope to appeal to the investors that do like that. And then what we also try and what we also include in this value proposition is the fact that we take full exposure to the gold price. So what we say to the market is, we'll run the business in such a way that if there's free cash, we'll distribute it. We'll pay a dividend. So hopefully that'll be some sort of reward for holding on to the stock. And then over and above that, we give you the opportunity to trade a relatively liquid stock with full exposure, that respond sharply to movements in the gold price, and we take full exposure to that gold price. So we don't try to pretend that we fix income or anything like that. And we're not in the business of revenue protection. We're in the business of taking exposure to the gold price and setting up the business in such a way that it can navigate the lean times, so that it does well during good cycles, like the one that position ourselves to take full advantage of those good cycles. In terms of growth as part of the value proposition has not really been our pitch. Although at this point in time, what we are saying to the market is that we're working on extending the life of our operations by between 18 and 20 years at this stage. And we're also looking at increasing output fairly significantly from roughly, the business is set up at the moment to produce between 155 and 160,000 ounces. And we're investing in infrastructure at this stage that will grow that by about 40,000 ounces by financial 2028, 2029, audit vision 28. So that is our value proposition. I haven't gone to the market, and I try not to try and read what it is that the market wants, because the moment you start shaping your business towards market appetite, you're going to run into trouble, because you're creating a false narrative here. You're creating something that's not based on the actual potential of your business. So our business, as I say, it's premised on those things. We pay a dividend. We've been doing it for 18 years. We take full exposure to the gold price, and we optimize our ore body. And optimizing our ore body at this stage means that we want to add another 40,000 ounces of production per annum from 2-3 years from now. Of course, we would like to grow as well, but I think at this stage, the only deal that you want to do in the gold space is you want to sell those assets that are risky, during the lean times, and you maybe want to own a drill and discover new resources. I don't know if you really want to be buying too many mines at this stage, because you're going to be buying assets that are up for sale because they no longer fit they become non-core. And non-core is just another word for these assets don't make money when times are hard. So we try to stay clear of that. Other kind of sort of corporate activity where it's, like for like, and both have had sort of a movement in their stock. Yeah, that might be slightly different, but you're not going to be writing big checks for assets at this stage. I don't think it's a good time to do that.
Okay, so if that's a strategy, and it's a perfectly reasonable one, how do you then go about balancing the growth story, exploration, development, along with the kind of discipline, of building up free cash flow, dividends paid, etc. Because they perform different functions.
So our growth story at the moment is a modest growth story. It's one premise on optimizing our existing asset portfolio. So in other words, increasing throughput capacity so that we can produce more for longer. That's the one part. And then positioning ourselves in such a way that at some point or another we might play a role in some sort of a regional consolidation. But that regional consolidation won't happen while those assets that we want to consolidate or incorporate into our business are priced at the levels that they're priced at the moment. I think there's a lot of ambition in the pricing from a seller's perspective in the pricing of some of those assets at the moment. And keep in mind that our business model is one of the retreatment of mine waste. If you can phrase that differently, you could call that environmental cleanup. And that's essentially what it boils down to if you do it properly. So most of the, let's call it, potential targets for regional consolidation are assets that, if they're not treated at some point or another, will become an ever-increasing environmental burden and balance sheet risk. So our growth story is not only modest, but it also requires patience, because you've got to wait for these things to become available at a price worth paying, and you don't want to overpay for waste. Waste is stuff that people throw away. The mere fact that we found out a way to treat it profitably doesn't suddenly turn it into something other than waste. It only becomes valuable if you have infrastructure capable of treating it at the right throughput rate, that it becomes valuable. So it's valuable in our hands. It's not necessarily valuable in other people's hands who don't have that infrastructure.
Well, I mean, that's a good point you make, and I think your previous point as well when you talk about M&A, not all projects are born equal. So how do you distinguish between a high quality gold project for you versus a marginal one? Obviously, ultimately, this is about making money in a sustained manner, and maybe an asset in your portfolio would operate differently in someone else's. So, but what do you think is important in terms of those marginal versus high quality equation? So
the corporate activity that one would consider would be some sort of a synergy exercise of sorts, where two assets that both achieve a particular quality threshold, that those assets are put together. I don't believe, different companies offer different value propositions. So that there are companies out there who would take a view on future cycles, and then they would take that view based on good data, and they have the risk appetite, and they also have the profile of companies that would take on the challenge of acquiring those assets during down cycles, because they're acquiring them on the premise that there's going to be a change in cycle, and they offer enormous returns if they get it right. And I mean the few that I know about that have done this successfully, it's very scientific. It's not random. It's not gambling. It's not random. They do proper studies, and they would buy these assets that are tough to manage. That you're always explaining to your shareholders why you believe you should be holding on to it. So companies get tired of having to, explain to shareholders and funds, institutional funds, why they're holding on to those assets. So those are the ones they target. They grab them, they optimize them. Typically they're really efficient. They can cut back costs and so forth. And then when that cycle turns, the results are spectacular. There's a place for that. We don't play in that. We don't play in that arena because we we don't have any experience in that sort of thing, and we're focusing on gold. And there's a particular niche that we've decided that we were going to dedicate our efforts to, and that is tailings retreatment. So the sort of value proposition that we offer is something completely different. And corporate activity in our space would be corporate activity involving assets where there's a particular quantitative threshold. And I know I talk about waste, but there's waste and then there's waste. There's some good waste and then there's bad waste. You would want to go for good waste that you can incorporate, or that would contribute towards your profile as hopefully a quality producer in that space.
Yeah. Okay. I mean, I think there's a whole kind of conversation there, which kind of is about, I guess, recoveries, payables, difference between oxides, refractory gold, and the impact of processing economics, which I think we've had a couple of those conversations in the past, but maybe not one for today. Because I think there's a kind of environment now where people are starting to understand that the timelines from discovery through to production is 15 to 20 years, and you got to fund that timeline, and that constant going out to market for more equity to move it along to a point where you can generate capital is, that's expensive money. We're seeing as a result, a lot of companies try to tell the story of a nearer term revenue story, where they're reducing the size of the capex to create smaller projects to just get some money flowing so that they can get out of that kind of vicious cycle. That's, you're in the game of efficiency. This is a less efficient solution from a production cost basis, but it's very efficient in terms of survival in the market and accessing capital to be able to put yourself in a position to be successful in the future. I mean, how do you've seen a few of those companies yourself, and do you think that model works, or could work?
Well, I think companies typically, the ones with the really good balance sheets, that they don't mind paying a premium for a quality asset, especially if it's in a quality jurisdiction. Not many companies nowadays have appetite to develop assets over 15 years. You still see them, but you've got to be in a really good jurisdiction, and you've got to have a really good asset in order to attract a long-term staying shareholder base for assets like that. What we do see is people try to sort of offset that or manage that risk by avoiding less than secure jurisdictions. If you don't know whether there's going to be some sort of a windfall tax, or they'll just walk in and take your gold. That's happening in one of the African jurisdictions recently, and they've actually lost a very good corporate operator in that jurisdiction, which I think will be to their disadvantage in future going forward. It wasn't a good relationship to spoil. I'm talking about from government's perspective, because this was a very responsible, very good operator that just decided, we're not going to hang around here any longer. So you would find that if there are long capex programs, predominantly they are in more established jurisdictions or more secure jurisdictions, less political volatility and good standards of political governance. Having said that, I suppose jurisdictions that in the past were deemed to be really secure suddenly have become a little bit volatile themselves. So but be that as it may, you've got to apply your formula and decide where you're going to go. Personally, I think that because of jurisdiction bias, that you would find that people overpay for relatively mediocre assets in good jurisdictions, and then they find themselves in a situation where they have to explain why their asset is not performing. It's one of the reasons really why we like the tailings space, though, because it doesn't take 15 years to develop a tailings operation. Not if you have established infrastructure the way that we have. In fact, most of the projects that we've done in the past were sort of within a 250 to 350 million rand range, and they didn't take much longer than 6 to 9 months to do. The only delays that we've had in the recent past have been regulatory delays, where we could maybe have done better with the licensing process and so forth. The project that we're running now, or the projects that we're running now, to extend the life of Far West and Ergo, these are the first projects that I can think of where the project lead time is is in excess of 2 years. So building these plants, building these tailings dams, is going to take us more than 2 years. So we don't like those long periods, and because we don't like to take on debt, and you don't want to be diluting your shareholders all the time in order to fund these projects. So I'm really sort of in the shorter term space.
Yeah, it's interesting because we often like write up states on how to interpret various aspects of the way that companies report things like the ASIC number, all the sustaining cost numbers, or even like putting out their kind of maiden resource numbers, and it's like it can be a little bit vague, it can be a little bit vague. Certainly initially, if it's your maiden resource, it's all just a little bit vague, and I think companies have a lot of leeway with things like it with all-in sustaining costs or all-in costs, because they can choose to include or exclude whatever they want on it there, and it's again trying to manage expectations in the market and maybe gloss over a few unwanted things, but it also adds to the kind of risk for investors in terms of how they interpret development plays purporting to be able to move into soon production phase, but they need to get the funding in place to allow them to kind of smooth out the bumps further down the line. So when you're sort of looking again in the marketplace, do you see sort of there are obviously lots of responsible companies, but are you also aware that perhaps there are companies which are less so?
No,
how do you spot them?
We've come up with all sorts of funny terms: profit and income and earnings. One would think that those are simple terms, and they become very, very complex terms. So you hear things like normalized earnings and all sorts of variations of EBITDA, et cetera, which is really just, it's all confusing. It's really confusing. I don't understand half of it, and I had no intention of trying to figure it out. Does it make money? What does the balance sheet look like? How much debt does it have? Does it make money? Does it cover its overhead? And can it pay its capital? Does it have the ability to invest in capex to fully optimize that business? We've had there was a company in South Africa, and everyone was invested in this company. It was just high flying company, and was just it had these huge profits, and it was this phenomenal growth profile. It was in the retail space, furniture retail. It was a global company. And it turned out to be a complete empty shell. It wasn't making any money. It was fabricating all sorts of numbers because it had become possible to do that without necessarily committing flagrant breaches of reporting standards. So I just think that we've made it so hard, and one more reason why I'm glad I'm in production and not managing other people's money, because how on earth? How do you interpret, if somebody tells you about his normalized earnings, really, what does that mean? You look at costs. Costs have just become such an opaque term. You look at these, as I said to you earlier, these ratios, these PE ratios, and then you look at the actual cash flows, and it doesn't make any sense. So I think it's become very, very confusing. So I keep it simple. Is there net cash flow? What does the balance sheet look like, the real balance sheet? And can they fund their capex? And you know what? A question that's not asked often enough, I believe, by investors is, what's the insurability of this company? How prepared are large, reputable insurance companies? How prepared are they to insure these companies for business interruption and for damage? Because insurers have a way of really sniffing out the smelly parts of a business, and your insurability oftentimes could give you a very good indication as to the general state of health of that company.
Yeah, I agree with it. As I kind of keep it simple, stupid, isn't it? Applies, and I think Charlie Munger used to call EBITDA bullshit for a reason. Focus on the money. Does it make money? Right, I'm just conscious of time, but there's a couple more questions I want to get into with you, if you don't mind. So, just looking back, what have you learned from kind of previous mining cycles, which you're applying to your strategy today in terms of the objectives that you set yourselves, the goals that you set yourselves, and how you sort of mitigate risk?
Well, it has definitely changed, because in the past I would say to you that if you're going to be investing capital, don't invest capital on the assumption of a different gold price, on the assumption of a higher gold price. If you need a higher gold price for your capital to work, for your investment to work, then maybe it's not a good project. I've changed that slightly. I'm thinking now, well, don't think that this gold price is going to last forever. So you have capital to invest it now, because you might not have the money to do that in a few years' time from now. The one thing that I suppose I could say that I sort of sense, looking back at some of the rapid changes in the past with regards to the gold price, is that we would discuss 10 different dynamics that support the gold price, and 10 potential dynamics that could negatively impact the gold price. And then there would be another dynamic that nobody even thought about. And that would be the reason why the gold price either goes up or why the gold price goes down. So you've got to listen, you've got to read, you've got to be smart about what's sustainable and what's not. And yeah, you really, sure, don't be a know-it-all, because if you think you've got this covered, then you probably don't. Then you're probably close to ending up on your backside.
I was saying the same thing to a CEO this morning. Don't get cocky, because this industry has a way of ruining your day.
Well, yeah.
Out of the blue.
This pony gets wild very, very quickly. I used to compare it to bull riding, except there's no 8-second rule. Hey, you got to hold on.
Yeah, you got to hold on. Niël, I appreciate your time today. Thank you very much for your insights, your knowledge. Obviously, nice to get a little update on how things are going with you guys. What are we going to see from you over the next 6 months down there at DRDGOLD?
Look, it's 100% focusing on getting these projects, maintaining momentum in these reinvestment projects. We spoke about the solar farm. We spoke about our regional tailings facility. The work that we're doing to one of our plants, and then there's some licensing stuff. We're in an interim phase now, and it will be a phase that we get to manage our way through, because Ergo, that was supposed to have closed 3 or 4 years ago based on its initial life of mine plan, is not closing, and extending the life of an operation like that, it takes grit and it takes determination, but we're getting there, and the focus going forward really is just going to make sure that we stick to the script and that we execute on these successfully.